Shares of Prestige Estates gain over 4% as the September quarter sales surge 50% to over 6,000 crore rupees, while collections rise 55%.
And Sathway Green Energy hits 10% upper circuit after reporting a solid set of numbers in the first quarter. The company's revenue rises nearly 4 times, while profit as well sees a multifold jump. The management says that they aspire to go at the current run rate, which means that they'll end the year at around 4,000 crores of revenues with margins in the vicinity of 15 to 16%.
Right, the pharmaceutical pack is gaining today, and in that there is an added advantage for Lupin, where it's announced a $250 million investment over the next 5 years to set up a manufacturing facility in Florida, the United States. They will have a capacity to produce over 25 respiratory drugs.
Senco Gold slips in trade as the record rally in gold and heavy rains in West Bengal take a toll on the company's September quarter. The management says it's confident of 18 to 20% revenue growth in FY26. Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, with me is Mangalam, and I think the indices should come to the top of the screen. They're trading in the green. They've been seesawing between the red as well as the green terrain for the time being, closer to around 25,100. I think, Mangalam, we have a job cut out on that front. The last couple of sessions, 25,200. That's where we're seeing some resistance. On the downside, though, the 24,900, I think that's the first support zone.
That's, extremely crucial. 24,900 at the lower level, 25,200 at the upper level. The important part is that today the broader markets are feeling a lot better than what they were yesterday. So we have the broader markets. The mid-cap index comes up for you, up around 0.5%. We have an even Steven sort of move coming in on the advanced decline ratio. So those two lines come up for you. They're pretty much, intact, in line with each other. The crisscross lines are now crissing and crossing, perhaps kissing each other between the red and the green. But the pharmaceutical pack, that really stands out as a gainer today. We have the Strides Pharma stock, which is up 7%. We're seeing, among the top frontline names as well, it's, Dr. Reddy's, which is doing well. Divi's has been doing well for third day in a row. So all these counters doing extremely well and fairly well bid in today's session. But this is the week of the IPOs. We've had multiple listings, a lot of offers as well. And now, today, another one opens. We have the IPO of Canara Robeco opening in. Rajneesh Narula, who's the MD and CEO, joins us on the show right now in the studio. Thanks a lot, Mr. Narula, for joining us in the studio. Always a pleasure. And, it's a time when what is doing well in the market shows versus what the offers are. We've had all the new age companies. We've had some of the old brands as well looking to unlock value. And now we have, the cult of the equity markets in India, the SIP investments and all of that come in. In that regard, Canara Robeco, the first obvious question is, while the markets are rising and the cult of equity investing in the country rises, for wealth managers like yourselves, what are the market share drivers and what are the revenue drivers from here on, over and above the fees and expense ratio that you charge?
Well, thank you very much. Thank you for having me in the studio this morning. Very happy to be here. Great question indeed. For us to do well, quite frankly, the markets, the India story has to play out. And clearly, we're structurally very well positioned today, as you're aware. Despite some global headwinds we see, I think the kind of reforms that you've seen in the country are fantastic. The GST reform in particular, as well as RBI has also put out a set of reforms. All that's very good for the market. We believe in the India story. As long as the economy does well, I know the markets will do well and we will do well. For us to gain more market share, it means more penetration, getting more distribution feet out as well, and having stronger relationships with partners. But the most important factor is performance. For us, fund performance matters. As long as we perform well in relation to benchmarks and competition, we will do well.
All right. Hi, Mr. Narula, and thanks a lot for coming down to the studio. If you could give us a few details then, how do you see the revenue mix changing going ahead? And what kind of growth momentum should you be looking at? We're not asking you about the near term because obviously you're in that silent period and regulations don't permit you. But in the next 3 to 5 years, what are the strategic goals that you have for the company?
Well, we have been, for the last 5 years, one of the fastest growing asset managers in the country. That clearly remains a priority for us to keep moving ahead of the market. Clearly, in terms of revenue as well, we have a great equity mix. As you can see, 91% of our AUM is equity. So that gives us leverage. And of course, the bigger the size, the bigger the operating leverage in our business. As you know, we are a capital light entity. And hence, capital for us basically goes towards creating talent as well as using it for infrastructure and technology.
All right. You said that you have to increase your penetration, you have to increase your distribution, and you have to obviously keep focusing on performance, etc. On all those parameters, if you could give us some sense, on the performance basis, where are you vis-a-vis everyone else in the industry? Are you in the top decile, the top quartile, or the top quintile, so to say? And at the same time, what is your distribution penetration strategy going to be, and how will that impact your margins?
Okay. For us, quite frankly, B30, for example, is an important measure. We have 24% of our AUM coming from B30 as compared to the industry. The industry gets about 18% from B30. So clearly, we have an advantage there. Our penetration strategy revolves around Canara Bank as well. They have close to 10,000 branches, so it helps us in terms of distribution footprint, and that also will give us better access to margins and yields.
Okay, all right. So Canara Bank as a percentage of your total mix, how much do they account for in terms of distribution?
Currently, it's about 8%.
Around 8%. All right. I'm just looking at your revenue breakup. There are basically two streams. One is the management fees and the advisory fees. Obviously, the advisory fees on a very low base has been growing. What's the typical revenue mix you're looking at?
Well, we'll continue to focus on the main business, which is the mutual fund operations, which is domestic. So a large proportion of our revenue will come from there.
Okay.
But we continue to grow the advisory piece as well.
Right. Now when we speak about the rise in the equity curve, there's also rise in competition. And big players have entered this market. I mean, you have BlackRock coming in, partnering with Jio. You know the distribution muscle, you know the strength, while everyone else will look to protect their turf as well and increase their penetration. In light of that, what would your strategy be? And would at that point, you have to pay a little more for talent, pay a little more for distribution, and could that impact your earnings?
Well, the fact that there are more players entering the industry means the industry's got a long runway here. So there's a lot of opportunity and growth in the industry that everyone sees. So clearly, that's a very good sign. The newer players, to my mind, they can get an initial head start depending on their brand. But post that, to build AUM, you need track record. In our industry, unlike others, you need to have a track record before you actually get money in. So for us, we already have built. We have all our schemes that are finished 10 years and above are actually performing higher than benchmarks. They beat the benchmarks as well on the equity side. So clearly, we have a head start there.
In terms of an AUM number, you'd like to put out a goal for the next 3 years or so? An aspiration. It's not a guidance.
So it's forward-looking. I think we would be very happy with the same trajectory that we have today.
You've grown around 25-30% approximately in terms of AUM, so you'll look to maintain that.
Yes, absolutely.
That means doubling every 3 years. So in the 3 years later when we speak, it'll be closer to 2 lakh crores, a little more than that, I guess.
Well, God willing. Thank you.
God willing. All right. This is an important question that everyone would be having on their mind. Every time there is a large global partnership, how long does that partnership last, or what happens of that partnership is crucial as well. So what are the terms with Robeco like? At what point do they come up for renewal, renegotiation, or anything of that sort? Because we've seen multiple, there have been instances, BlackRock, for instance, as well. Earlier was DSP and now it's Geofin. So all these partnerships, how sustainable is this right now, and how fortified is your terms with Robeco?
Well, we're very fortunate, actually. We're fortunate that we have global partners that are extremely stable, long-term oriented, and we believe that focus will continue. We expect them to be long-term oriented as well.
And from a business standpoint, how do you think one should value these companies? Largely because when we started out, it was 1.5% to 2% of AUM should be the market cap. That was the rule of the thumb. Now that increased to 3%, 4%. You're offered anywhere between 4 to 5% of your current AUM projections as well. So what do you think is fundamentally, you guys obviously look at companies, you guys value companies. So from an AUM business standpoint, what do you think is a good ratio?
Well, it's an interesting question as well. You're right. Previously, the evaluation was based on AUM. That has changed. So as you're aware, we go through a book building process, which the BRMs carry out. They discover price through the anchor book as well. So clearly, it's a market discovered price. And it's more focused towards PAT now. So it's a multiple of PAT in our business that's important.
27, 28 times trailing?
Yeah, as of now, yes.
As of now.
Okay, all right, Mr. Narula, we thank you for coming down to the studio and explaining your business model to us. Wish you all the best with regard to the IPO. And on listing, you're going to be back on our show giving us some more concrete details. But all the best.
And we'll squeeze you a lot more for the numbers that time around. So
thank you.
Stay tuned for that.
Thank you. Appreciate it. Thank you. Bye-bye.
All right. Have a good day ahead. For the time being, guys, what we'll do is we'll slip into a short break, come back, continue to focus on markets and stocks that are moving around.
PG Electroplast up 6% right now. And the other one which is doing well is Vodafone Idea. As the UK Prime Minister is currently in India, everyone's speculating on whether there would be some sort of relief or not coming by for Vodafone. That stock up around 2.5% has been bidding, or has been bid well in the last few trading sessions itself. But the stock of the moment, definitely PG Electroplast, up around 6.5%. We take a short break. In fact, no, before we do that, let's shift focus to the Global FinTech Fest. KV Kamath, the chairman of Jio Financial Services, spoke exclusively to CNBC-TV18 from the sidelines of the GFF. Ritu was in conversation with him, began by asking him about the recent regulatory changes announced by the RBI.
I look at it on a very broad frame, as it were. If I look at a few years back, what a bank could do and where we were at this point in time, for a variety of reasons, banks which were primarily in corporate lending, working capital and corporate loans, and also infrastructure credit. So one side of the book, more than 50% was these type of assets. The other side was retail assets. That has flipped, and particularly post-COVID, that has flipped in a very hard way, where you now have a majority of the assets retail, and then you have corporate. To me, what it meant was that banks were missing out on opportunities in an economy which is growing around, let me round out the number, at 7%. So in a 7% economy, the key driver is going to be your corporate side of the economy. And the banks were somehow getting left out of that sector for a variety of reasons, some of which have been now addressed. There are other reasons which are more structural. For example, there's greater access to capital markets now, which till 5-7 years back, the pension industry, the long-term savings industry, the insurance industry, the MF industry was still growing. But now it's growing at a pace. So good corporates, large corporates can access that market directly. And so the banks, in a way where you could see in their capital adequacy was very flush, as it were. So I think this opens up equal opportunity in a way for banks. And to me, it is excellent news.
But, in terms of signaling from RBI, do you think this is a very different regulator than what we had a few years ago? And, is the signal that this is a more growth-friendly regulation, or as some in the industry have expressed concerns, some of the dilution of prudential, guardrails as well?
No, I don't agree with that second proposition up front. In my 55 years in business, I have not seen the RBI, not taking its eye off the ball. They're never ever. They are always very focused. So that is not an issue. In terms of various regulators, regulatory heads doing various things over a period of time. Again, when I look at things over time, and particularly from '96, when I was in a, I'd say, position where I could take a better look, regulation has always followed what is possible given the environment. So we must remember, sometimes we don't put it into context. We hit $500 billion as a GDP only in 2004. So the regulations that were appropriate for that period of time were in place during that point of time. That is, as we headed from $250 billion to $500 billion. And I think it took us 20 or 25 years. Regulations were appropriate. And we might have had views on that, but they were appropriate. And then growth started, growth momentum started. And we could see easing happening. So I would think that at each point in time, every 5 years, let us say, in RBI, I have seen an evolution in terms of how they look at what they need to do in the context of the overall economy, in a policy construct and a supervisory construct. So I think what they have done is appropriate, considering where we are
at the moment.
This moment.
Sir, M&E financing, how significant is it allowing banks to finance acquisitions? Because, what has really changed from RBI earlier not wanting to allow banks to do it to now, changing its stance on the matter?
We actually have to go back to answer this question many decades.
Yeah.
And, some of us, I think, are too young to have understood why this was not done. So there was a period of time when we thought acquisition by one company of another company typically is a hostile route. And that the bank should not be an instrument in doing this. So this was long back. So I think that has now been set right in current context, where everything is the market and everything goes through the marketplace. And in any case, if acquisition financing has to be done, there are other people providing private credit to do this, or you go through the capital market route and do this. So I would think, looking at the risks at that point in time, the way business was being done at that point in time, that was something that was not allowed. And now, in a completely different context, I believe the Reserve Bank has done the right thing to open it up, because it's an excellent avenue of business for banks.
Yeah, how much credit do you think all of these measures put together could really unlock? And more importantly, while this is an enabler for banks to lend more, is there real demand on the ground from corporates, given the deleveraging cycle we've seen and the global uncertainties?
There are two different things here.
Yeah.
Deleveraging, I think, is now a mindset issue with the Indian corporate. They will not leverage themselves, by and large, the larger company. I think at the MSME end, that will happen in due course. But we are talking of the mid to large corporates. So it's not a question of deleveraging. This was for business purpose and acquisition. And in most cases, these acquisitions are in a friendly mode.
Not hostile takeover.
So now you need to, it's not hostile, but you need to understand whether there are risks. What are the securities? What is the underlying value of those securities? All those, that analytical skill is required, and I'm sure banks will come up to speed on that. Now, your question was, is there demand? I'll say this, I'll not put a number to it, but every single, I would say, global entity that I talk to, of whatever type, if they are in the financial services business, so I'm not naming it, it's a bank, non-bank, investment bank, I'm saying every single entity in the financial services business globally, we're looking at India as a great place to come and set up a private credit business. Bringing in external funding and then providing this credit, which Indian banks were not allowed to do for the marketplace. So the curiosity that was there, the interest that was there, and the opportunity that they saw, to me means that it was a very large number that is being talked about.
All right. Well, time to slip into a quick break. Come back. Continue to focus on markets and stock-specific action. Stay tuned. Welcome back. Well, the market's trading in the green. The Nifty is closer to around the 25,100 mark. Briefly, we went into the red, but it's recouped, most of those losses. And as you can see, even the Nifty Bank, that's the top of Mangalam, well, that one, in fact, has moved into the green. And the breadth of the market firmly in favor of the number of stocks advancing, then declining. So, Mangalam, we have done a bit. I think over to the team of
Over to the team of Trading Hour. Thank you so much for watching Chartbusters. Let's hold this market up until the team of Trading Hour comes out.